Okay. I think we're going. And welcome back. Last day of rapid class. Going to cover 2 chapters today. I'm just checking on things here. Okay. I just wish that would refresh. I'd be about more comfortable if it did, but we'll try and continue on. Hopefully everything's working out okay. We're going to cover chapters 9 and 12 out of the basic class book today. I will mention and give the basic rules for some of the credits that we are skipping that are in chapters uh, 10 and 11. You can always go back and watch the basic class to pick those up. To pass the test, you would actually need that information, but like we said, the whole idea about this class and this structure is to get you on the ground running for most of the early season returns that's going to walk through the door, and those other credits very are not as common as the ones that we're going to talk about today. And then the Schedule C, this profit or loss from business, just a touch on it, and it's still you'll have the information, the knowledge to work through the simplest of them. But again, we're not going to cover everything you need to know to do every last Schedule C that's going to walk through the door, because there's a lot of information that is outside of the scope of this class. And even as an office, we don't give Schedule C's to first year tax preparers unless it's just dead on simple or it's a slow day, and we have somebody with more experience that can sit there, walk with you through it. So, but first things first, let's talk about the other chapter. We're going to talk about child tax credit, the additional child tax credit, and the other dependents credit. We've been mentioning these as we went along, and it's time to finally take care of it. Alright. Good, I think everything's going. Like we said, in this chapter, the child tax credit, the additional child tax credit, credit for other dependents, the credit for child and dependent expenses, and the adoption credit is talked about in this chapter. I am not going to talk about it. It is something very rare. In 20 years, I've done the adoption credit once. So if you need it, go back and review, look it up. Go to IRS, go to Publication 17, go to the go to Liberty Resource Center and under e-learning, and look up this chapter. Watch the video that I made for the basic class. We cover it in there. So let's just go what we got. Again, distinguish between non-refundable and refundable credits. We have both today. Identify the credits that are based on dependents. Well, that's the whole idea behind child tax credit. And the other dependent credit. It's right in the name. Know how to figure and report credits based on dependents. And a little bit more about due diligence, but really my big sell on due diligence was last class, so again, I'm not going to spend a lot of time, if any, talking about due diligence again. It's important. Don't get me wrong. I'm not blowing it off, but it is something that I feel is natural in our offices, the way that we have them set up, the way that we have our policies and procedures. No return gets transmitted to the IRS unless a second pair of eyes that had nothing to do with the return has had a chance to look at it to make sure it makes sense to them, just as a reviewer. And if it's not, then we send it back to the person who did it and say, hey, I have questions. Either fill me in, get me up to speed, or get the client back in here and, get these questions answered. All right. So, child tax credit, which, let me grab my papers here and make sure that and of course I didn't print them out. Give me just 1 second. I want to have the most current information at my disposal because there is a change to the child tax credit this year. Okay, so to be eligible for the child tax credit or the additional child tax credit, the child must have a valid Social Security number, not an I-10, by the due date of the return, including extensions. So you technically have until October 15th, providing you actually did file the extension, to get a Social Security number for a child that you want to claim for child tax credit, for other dependent credit, for the additional child tax credit. Credit can no longer be claimed if the qualifying child has an I-10. However, a qualifying child with an I-10 may qualify for the other dependents credit, which is going to be talked about in a little bit. Child tax credit is non-refundable. And therefore, the best you can do with child tax credit is pay all of the taxes that you owe. Theoretically, what's left over you don't get, but that's where the additional child tax credit pops in. We're going to talk about it in a second. Says that it provides a tax credit up to $2,000 for each qualifying child. That is old information. The new child tax credit is $2,200 per qualifying child. But the examples that we have, they're going to be based over the 2000. Just keep that in mind when you take the exam. It's based over the 24 information, so the 2000, not the 2200. Ed, Marcy, 2 qualified children eligible to take the child tax credit of 2000 for each. That's $4,000 of total tax credits. Line 60 and 1040, which is the taxes they owe, is $2,670. So they claim a child tax credit of $2,670. So they owe no tax. They don't get the additional $1,330 unless they can claim it as a part of the additional child tax credit. To be eligible to claim the child tax credit, you must have at least one qualifying child. Well, yeah, it is child tax credit for a reason. To be a qualified child for the credit, the child must be listed on your return as a dependent. Remember, we've been talking about this. The additional child tax credit, are the 2 credits that are transferable with an 8332 to the non-custodial parent. Child tax credit is available for all filing statuses, so even married filing separately can claim this credit. If you incorrectly claim child tax credit or the additional child tax credit when you're not eligible for the credit, you can be banned from claiming this credit for 2 or 10 years. If they determine that it's fraud, it's 2 years. If it's a mathematical error, I mean, that's not a big deal. And you know, that's not where this is. This is people that are just being either reckless or outright fraudulent. And this is true for the earned income credit that we talked about yesterday. That same sentence can be said. If you get caught taking advantage of earned income credit, if it's just kind of a minor mistake, a miscalculation, no big deal. If it's, well, you're pushing the limits, they can ban you for 2 years. And if it's an out-and-out fraud situation, they can ban you for 10. Child tax credit is on line 19 of your 1040. Again, I don't worry about line numbers on 1040s. They move. Additional child tax credit is determined on Schedule 8812. claimed on line 28 of 1040. Well, that's the difference here. 19 is in the non-refundable credit section. 28 is in the refundable credit section. All right. The qualifying child for this purposes of this credit is a child who meets all the following criteria. And you've heard these before, because guess what? To be a qualifying child for child tax credit, they must be a qualifying child as a dependent. So the rules are going to be the same. Child is your son, daughter, stepchild, foster child, brother, sister, stepbrother, stepsister, or descendant of any of them. Grandchild counts. Great-grandchildren counts. Great-great-grandchildren, so on and so forth. How far you want to go is how far you can go. An adopted child is yours. The child must be under the age of 17 at the end of the year. Again, this is another one of those places where, as a tax preparer, always be looking to be in front of a problem. If your client is listing a dependent on their tax return that's 16 years old, we need to be telling them, hey, this year so-and-so helped you qualify for child tax credit. That was a $2,000 credit, $2,200 credit, depending on the year. Next year, they aged out. They turned 17. You can't claim them for that credit anymore. And then go through their return. Barring any other changes, your refund's going to go down $2,000. And so, is their refund big enough to handle it? Or do they need to make some changes on their W-4s at work? Like I said, this is where one of the places where we prove our worth. Helping the client be in front of potential problems. Yeah, sure, I could say nothing and they'll come back next year and I'll do their taxes and the situation will have changed for them and they'll get a smaller refund. They probably won't even blame me for it once you explain it to them. Well, hey, they no longer qualify for this credit. They aged out. Well, okay, yeah. It's your fault, my fault, nobody's fault, but being a good tax preparer, hey, I told you about it last year, remember? Rule number 3, the child did not provide over half of his or her own support during the tax year. We've seen that rule before. Again, I don't care if the child makes $1 million. That's not the point. The point is that who's buying the Cocoa Puffs? Who's buying the Lucky Charms? Who's paying for a house? Who's paying for the clothes? Those are the questions that you're really asking. The child must have lived with you for more than half of the taxable year. However, there are special circumstances that we've talked about before, for work, for vacation, for education. Exception for children of divorced or separated parents. Remember, this is the tax credit that can be signed over with the 8332 to the non-custodial parent, and they can still get this tax credit. So we don't have to worry about that part. Qualifying child is one who would have been living with you throughout the tax year had they not been born or have died during the tax year. That's kind of a temporary circumstance. I mean, I realize it's permanent, but you get the gist of it. All they had to do is have a certificate of live birth. They could have been born and died on the same day. They'd still qualify for child tax credit for the entire year. Rule number 5, you must claim the child as your dependent. You must have people listed in your dependent section of your 1040 to be able to qualify for this credit. The child did not file a joint return for the year or only did so to get back taxes that were withheld. Again, consistent rule. Child must be a citizen or resident of the United States or United States national and must have a valid Social Security number. There are some special rules for children divorced or separated parents, as well as for children who lived apart from their parents, or parents who lived apart. The custodial parent is the parent with whom the child lived with the greater number of nights. The other parent's non-custodial. Custodial parent is not established by any court document. It's established by physical residence. And that's one of those things that we're asking for when we're doing the tax returns. Hey, just give me a piece of mail from an uninterested third party that's to you at your place about this person, or to your child at your place. It doesn't matter how those and school forms are great. Doctor's bills are fine. Uh, if they got their Social Security card, if they're newborn, they got their Social Security card this year. Great, as long as it's not detached from the address form, it's perfect. In Kansas, hey, a lot of our clients, especially in the early part of the season, are on cane care with their children. Give me the cane care letter for this year. Had them sign up for free and reduced lunch. Are they on the lease? All of those things help me. It's just that little extra proof that I need to show due diligence. And it's also handy because if the client gets a letter, I already have all the information they need. In most cases, the qualifying child is considered dependent of the custodial parent unless the 8332 has been signed. Then we can sign that over just like we've got going on here. Child tax credit. The additional child tax credit can be transferred with the 8332. So Courtney's 13, lived with her father Calvin. Calvin has signed a written declaration form that he will not claim Courtney as a dependent. Courtney is not a qualifying child for the child tax credit for Calvin. She is the qualifying child of his former wife. Calvin's former wife can claim child tax credit on her and the additional child tax credit because she's claiming the child as a dependent. If the child is the qualifying child of more than one person, only one person can claim the child as a qualifying child for all the tax benefits unless there are rules that of children of divorced or separated parents or never married parents apply. And remember, we can't transfer over head of household. We can't transfer over child and dependent care expenses. Can't transfer over earned income credit. No other person can take any of these credits based on the same child. There's no halvesies. If more than one person files for the same person, the IRS will disallow all but one using tiebreaker rules, and it might take years. I had one client, it took them 7 years to determine that, yes, indeed, my client, who unfortunately filed second, was the one who should have been claiming the child as a dependent this entire time. It was nerve-wracking to say the least for my client, but it worked out in the end. But like I said, it took 7 years for the IRS to finally determine that she was in the right and the baby's father was making a bad claim. Back to the tiebreaker rules. If only one person is the child's parent, then the child is treated as the qualifying child of the parent. A biological parent will always win. If the parents file a joint return together and can claim the child as the qualifying child, the child is treated as the qualifying child of the parents. Whether they claimed him or not, that's not the point. Excuse me. The point is that the child should have stayed with the parents at that point, as far as taxes are concerned. If the parents do not file a joint return together, but both parents claim the child as a qualifying child, the IRS will treat the child as a qualifying child of the parent with whom the child lived with a longer period of time during the year. If the child lived with each parent for the same amount of time, the child will be the qualifying child of the parent who had the higher adjusted gross income for the year. If no parent can claim the qualifying child, the child is treated as the qualifying child of the person who had the highest AGI. So if you have two sets of grandparents that are trying to make a claim, then neither one of them are biological, so we're looking at highest adjusted gross income of them, and actually we're looking at all three. Those grandparents, these grandparents, and the parents, because if their parents' adjusted gross income is the highest of all three, even though they might have not have claimed this child, they should have, and the IRS is not going to let anybody else do it, no matter at that fact that nobody did. Tom, Tina, son 13, daughter 12, also cared for a 14-year-old nephew since his parents passed away 2 years ago. They provide all the support for their nephews and can claim him as a dependent. He's a qualifying child for the child tax credit. So in this case, the Tom and Tina have 3 qualifying children for the child tax credit. Yeah, and that's not all. They could go even farther. The whole point here is that child tax credit has no limit as long as we have as long as we have a child who was born during this year and is under the age of 17. You qualify for child tax. They qualify for child tax credit. You can have 10 kids. They can all qualify, providing they're within the age range, and of course the other criteria. But In dependent section of 1040, you must provide the child's name as well as the valid social security number and their relationship to you. And if you go farther, unfortunately, they don't get added on. I mean, they do. They're attached to the return. The IRS sees them. But on the paperwork that prints out, 4 lines is the max. So you can have more kids on there, but they might not show up, at least on that paper for electronically filed returns. The amount of non-refundable child tax credit is claimed on line 19. It's reduced if your tax is less than your credit. Well, of course, it's non-refundable credit. So if I only owe $500 in tax and I qualify for a $2,000 credit, well, but it's non-refundable, so I only have a $500 credit because that's all I needed. Modified adjusted gross income is below the threshold amount for your filing status. Married filing jointly must make less than $400,000. All other filing status must make less than $200,000. If you make more than that, we start adjusting. The maximum child tax credit is reduced by $50 for every $1,000 over the threshold. So child tax credit is completely phased out for adjusted gross income of $40,000 per child, i.e., $2,000 maximum credit divided by 5. $50 per 1,000 over the threshold limit. So basically, what we're saying here is we start phasing your refundable or your non-refundable credit down once you reach $400,000 to $200,000, and you're completely out of credit at $440,000 or $240,000. So this is restating what I just said. Married couple, 2 qualified children, filing a joint return would be able to claim a child tax credit of $4,000 if they kept it below $400,000, $2,000 as long as they kept it below $440,000, and $0 if they're at $480,000. Well, in this case, at $480,000 because we have 2 kids. If you receive less than the full amount of the child tax credit because the tax was less than the credit, you may qualify for the additional child tax credit. If you do not get the full $2,000 or $200, remember, of child tax credit, you may be able to qualify for the additional child tax credit. That's up to $1,700 for each qualifying child. Additional child tax credit is the smaller of 15% of your taxable earned income over $2,500, or the amount of unused credit remaining after reducing the regular tax limited to $1,700 per child. So if you're low income, you might not get all of the additional child tax credit. So do keep that in mind. It's not straightforward, what's ever left over, I get $1,700. Well, no, that's not true. If your income was very low, it's going to be adjusted. Combat pay is included when figuring taxable earned income. Doesn't change the amount of tax, it just changes your calculations. Basically, it's designed to help you qualify for the full amount. This is a refundable credit, so what you don't use, what you don't need to pay taxes, is part of your refund that'll be sent to you. Excuse me. Form for this is 8812. So Marvin and Maud, taxable earned income is $19,400, sorry. They have 2 qualifying children. Their tax liability is $19,443. Because their tax liability is less than the full amount of their credit, in this case they have a $4,000 child tax credit, they may be able to take the additional child tax credit of $2,057. So the $4,000 minus the $19,443 that they needed to pay their taxes, but it might not be that full amount because this income is kind of low. There's another method to compute the additional child tax credit for taxpayers with 3 or more. These taxpayers may benefit if they had Social Security or Medicare taxes paid, they were self-employed and paid self-employment tax, paid tax on tips not reported to their employer, did not receive the maximum available child tax credit. This is also factored in 8812. I'm not going to spend a lot of time worrying about this with you. If it's triggered, Fusion will grab it. Just put this in your head that if, well, I don't know, the additional child tax credit's actually a little bit more than I thought it would be. This is one of the reasons why. It's not a computer error. It's not a software problem. There is a trigger where you can get some Social Security, get some credit, basically, for having paid Social Security and Medicare taxes with a larger family. If your additional child tax credit is limited because of the amount of your earned income, and you have 3 or 4, you still might be able to get more of child tax credit based on what we just saw. John, Jane, married, filed joint return, $90,000, AGI 95.1. Taxable income after taking standard deduction or itemized deductions. I'm not going to run the math here. 65.9. They owe $7,447 in tax. They have 3 qualifying children, or 12, 9, and 5. They claim $6,000 for child tax credit, $2,000 for each of the 3 children. And so we're going to look at their worksheet for the child tax credit and the additional child tax credit. One thing I want to point out here actually is on this credit limit worksheet, because it's not covered horribly well in the scope of the lecture. So I'm going to take the opportunity right here to explain it. We have a number of non-refundable credits. Each one of these lines up here is actually representing a different non-refundable credit, which this one line here should represent the child tax credit. No. Well, each one of these represents a different non-refundable credit. As you can see, and the nice thing is that we're going to use all the non-refundable credits that we qualified for before we start tapping into the non-refundable child tax credit. That way we're maximizing the amount of money that's being left over for the additional child tax credit. This is by rule. Again, they're using the child tax credit last to maximize the amount of money available for the additional child tax credit. Excuse me. And these are just examples of our example earlier, showing you the differences of how to figure out child tax credit and the additional child tax credit, because we know we have it. We have 6,000. Well, okay. The first time we don't, because they're still going to owe $1,014.47 because they didn't have enough child tax credit to cover all they owed in tax. But here they changed it. Taxable income of $34,550, so now their what they owe before credits is $36.85. And so we're going back and taking a look. Now we had money left over to go to the additional child tax credit. And they're going to get additional child tax credit of $23.15. Again, this is how it looks like on paper. You know, the computer handles all of this for you, so it's not really something you need to really panic about. Oh my God, how do I do that? No, all this just happens in the background. Alright, other dependent credit. Beginning in 2018, this credit was established. $500 non-refundable for taxpayers with dependents who meet additional conditions. So if they didn't qualify, if they didn't qualify to be child tax credit, you still might qualify for this $500 non-refundable other dependent credit. So like your child aged out. They turned 17 this year. They're still dependent on your return, but not eligible for child tax credit. They are eligible for this other dependent credit. If the person meets all the following conditions, they qualify for the other dependent credit. They're claimed on your tax return as a dependent. They weren't by anybody, including you, to claim child tax credit. Or in this case, they're also saying person cannot be used by you to claim child tax credit. So, for example, like I said, child 17 aged out of child tax credit, but this other dependent credit is still available. Person is citizen, national, or U.S. resident. Residents of Mexico or Canada do not meet the definition of qualifying dependent for this credit. No age limit for a dependent who files for this credit. Thus, child over 17 who no longer qualifies for the child tax credit may be allowed to qualify for this $500 other dependent credit. The ODC is treated as part of the regular child tax credit and determine the amount of credit reduction. For higher income taxpayers, to qualify for the other dependent credit, the person must have a tax identification number, whether it's social, individual tax, or adoption tax. Got to have some sort of number. So Carla, child who would otherwise be a qualifying child for the purpose of the child tax credit, but the child has an ITIN, not a social security number, so they can't claim child tax credit. But they still could claim the $500 other dependent credit. Randy, Sandy, joint return, both have social security numbers, tax liability is $2,000. 3 qualifying dependents, Mark, 18, social security number meets the qualifying dependent test. Katie May, 15, adopted, has an ITIN, meets the qualifying dependent test. Randy's mother, Lee Ann, 62, valid social security number. All 3 of these people meet the relative test, meet the dependent test, but none of them qualify for child tax credit because of either age or tax identification number. But they all 3 qualify for $500 each of other dependent credit. So Randy and Sandy have $1,500 available of non-refundable credits. Now we have same as example 1, except that the Does have a 4th child who is 18. So they've added in another person who qualifies for the other dependent credit. Reminding yourself that due diligence is an important thing. Due diligence really comes into play, especially on refundable type credits. So IRS is really concerned. They're always concerned about due diligence, but they're super concerned about due diligence when it comes to earned income credit, child tax credit, the additional child tax credit, the American Opportunity Credit, and the head of household filing statuses. Alright, the other tax credit we're going to talk about in the scope of this chapter, and I'm kind of going to maybe accelerate a little bit. It's not the greatest credit in the world. If you pay someone to care for your child or other dependents so you can work, you may be eligible for this credit. The credit for child and dependent care expenses is non-refundable. So it means that you can't, the best you could possibly do is pay off your taxes. You can't get a refund based off of this credit by itself. 2441 is your form. To qualify for this, you must meet all of the requirements. You're eligible to claim the child and dependent care expenses. First, the care is for one or more qualifying persons. A qualifying person for the child and dependent care expense the credit is a child who was under the age of 13 when the care was provided and whom you can claim as a dependent. This is important. This under the age of 13 when the care was provided. It's an outlier in the regards that IRS is always like whatever your status was on the last day of the tax year, except for this one. You can claim the dependent credit, or not the dependent credit, the child and dependent care credit up until the time that they turn 13. So if they turn 13 in August, you can claim the credit for expenses up until their 13th birthday in August. If they continue to go on, you can't, unless they're physically or mentally incapable of self-care and lived with you for more than half the year. This is a person who is mentally or physically incapable of self-care, lived with you for more than half the year, whom you can claim as a dependent, or whom you could have claimed except they made too much money, had filed a joint return, or you or your spouse are married, finally jointly can be claimed as a dependent in somebody else's return. The dependent is a person other than you or your spouse who can be claimed on your tax return. But I could take the child dependent care credit for my spouse if I needed it. To be a dependent, the person must be a qualifying child or a qualifying relative. Claire and her husband Tom live together for the entire year. Clara pays someone to care for Tom so she can go to work. Tom is physically unable to care for himself. Tom is a qualifying person in this case. But there's another way to look at this, and look at this two different ways, because the person coming in to care for Tom in this physically unable status might be a nurse. So therefore, this also could be eligible for medical deduction on Schedule A. Now I have to choose one or the other. I can't do both. But run it both ways. See what gives them the maximum amount of credit. And it's going to be different because remember, when we're doing adjustments to income, I'm changing your taxable income, thereby lowering your taxes to begin with, as opposed to this credit, which is paying off taxes that were already figured. Blair pays someone to care for her son Eddie while she works. Eddie turned 13 on August 10th. While under 13, Eddie was a qualifying person. After he turned 13, he's not, for the purposes of the credit. Blair can use the expenses she paid through August 9th to figure the credit. Maria, 28, not mentally able to care for herself. She lived with her brother for more than half the year, and he pays someone to care for her while he works. He supports Maria, can claim her as a dependent. Maria is a qualifying person. Her brother can claim the credit using the expenses he paid. Again, I would look at it from two different directions, though, because the person who's coming in might be a medical professional. In that case, then those expenses also are eligible to be used on Schedule A, which gives the brother the better result. In the case of divorce of separated parents, the child is treated as the qualifying child of the custodial parent. If you're not a custodial parent, you cannot treat the child as a qualifying person for this dependent care expense, even if you can claim the child as a dependent, or even if you're the one who are actually paying for the babysitter. If you're not the custodial parent, well, thank you for paying, but you don't get any credit for it. Alan and Samantha divorced. Daughter Judy, 11, lived with Samantha for 9 months. The remaining 3 months she lived with Alan. Samantha signing a statement allowing Alan to claim. Judy as a dependent. Samantha pays for child care for Judy so she could work because she's a custodial parent. Samantha can treat Judy as the qualifying person for the credit, for the child dependent care credit. Even though Samantha cannot claim Judy as a dependent, she could have. She just signed it over. Alan can't do it, even though he's claiming Judy as a dependent. Another test that we have to look at to be able to qualify for this test is that you have to have some earned income. Earned income also not only includes what you get paid for working a W-2 job, it also could be net income from self-employment. You can also elect to include non-taxable combat pay to help you maximize the credit if it helps. Earned income credit does not include earnings while incarcerated or in a work release program, which is fine because you don't have a dependent at that point anyway. I don't need to pay for child dependent care expenses. I'm in the slam. They can't live here. A spouse is treated as having earned income for any month that the spouse is a full-time student or was physically or mentally incapable of self-care. This is where it gets a little fuzzy on this credit. This is where it gets a little more confusing. To be considered full-time student, the spouse must have been a student for some part of each 5 calendar months during the year. The income for the non-working spouse is to be considered at least $250 with one qualifying person, or 5 with 2 or more qualifying persons for each month the spouse is a student or is disabled. So for the purposes of this credit, even if they didn't make a dime throughout the year, as long as they were enrolled in school for at least 5 months, that person gets $250 a month of fake earned income for the purposes of figuring this credit. Well, and this is important on a couple of different fronts. Now, we have an example that's going to be running through here that will help us get our hand around the non-working spouse who's going to school. But if we're married, filing jointly, and only one spouse works, you're not going to qualify for this credit because the other spouse isn't doing anything. They're the ones that should be taking care of the child. And that's just the way that's the way I looked at it. So our example that we're going to be running through here, Barbara and her husband Grant paid child care expenses for their 3-year-old daughter Susan. Barbara worked as a lab tech. She earned $50. Grant, full-time student from August to December, so and his earned income is going to be $12.50. That's 5 months at $250 of fake income for the purposes of this credit. This rule applies to only one spouse for any 1 month. If the same month both you and your spouse didn't work and either full-time students or not physically or mentally able to care for yourselves, the only one of you can be treated as having earned income for that month. And you're not going to qualify for the credit for that month, basically, is what it's saying. I mean, well, again, here's what it's kind of saying is that, well, you're both home. You should schedule your classes a little bit better so at least one of you could watch your own kid. It's kind of what it's saying. The care is provided for the qualifying person so you or your spouse, and your spouse, I should say, can work, or at least look for it. It's not enough that you incurred the expense while you're working. The purpose of the expense must be to allow you to work. Whether your expense is incurred to allow you to work or look for work depends on the facts and circumstances. First, you must receive payment for the work. If you're doing unpaid volunteer work and send the kid off to daycare, sorry, you can't take the credit for at least that month. Work includes actively looking for a paying job if you have some earned income during the year. If I didn't find a job for the year, I have no earned income for the year, I have no credit for the year. Of course, if I didn't have any income for the year, I have no tax for the year. If this is a non-refundable credit, it was worthless anyway. Your spouse who is incapable of self-care or a full-time student for some part of each 5 months is going to be treated as working. So remember that grant example that we're going to have running through here. Maxine, 2 children, pays daycare to take care of her children 3 days a week so she can volunteer and run errands. Maxine does not have any earned income because Maxine is not paying for child care expenses so she can work. She can't claim the credit. Work-related expenses cannot be paid to certain related parties. The care provider cannot be your spouse. You can't pay your spouse to watch your own kid. Can't be the parent of your qualifying person, so it can't pay the ex-wife to watch the kid. Can't be your child who's under the age of 19 or a dependent that's claimed on your tax return. You can count work-related payments to relatives who are not your dependents even if they live in the home. Yeah, grandma's living in the home. I'm not claiming grandma as a dependent because she's still working a little bit and making enough money. But her schedule works around my schedule so that when Junior's home from school, she can watch him. So I pay mom or the grandma to watch the kid. That's an acceptable expense. However, there's another side to this. When we actually fill out this form, we are going to be telling the IRS with a tax identification number who we paid to watch the kid. Guess what? If I say that I'm paying Grandma to watch the kid, Grandma better report that income on her tax return because the IRS is going to be looking for it. Ashley and her son lived with her mother, Maddie. Ashley pays Maddie to take care of her 6-year-old son so she can work. Maddie is not claiming as a dependent on Ashley's return. Ashley can claim the credit using the amount that she pays Maddie. Just remember, Maddie better report that income or the IRS is going to be sending them some hate mail. Married generally must file a joint return, so married filing separately need not apply. Of course, the head of a household considered unmarried does work here. You must identify all persons and organizations that provided the child care by name, address, and tax identification number, whether it's a social security number, individual tax identification number, or employee identification number. Any of those are tax identification numbers. Any of those can work. If you cannot provide all the required information, you must be able to show you use due diligence in trying to obtain such information. Some places don't want to give you this information. Why? Well, it's kind of under the table. I've heard of one place that you paid a certain amount to have your kid watched by them if you wanted a receipt, and you paid a less amount to have your kid watched by them if you didn't want a receipt. Do you really want to leave your kid there with people that are running a business like that? That's kind of scary. And I've had this. So I told somebody about, hey, you have a kid, you're working. Who's watching the kid while you're away at work? It's a daycare. What, can you get a receipt? You qualify for a tax credit. Oh, okay, I didn't know that. Okay, I'll call them up and get a receipt. And then they called up and asked for a receipt, and they said, no, I'm not going to give you one. Well, what's that mean? Well, yeah, the same thing. They're not reporting that income to the IRS. Now, my client can still take the credit by providing as much information as they possibly can, so they know the name of the individual, they know the address of where the daycare actually is. That's enough for the IRS to actually come back and audit them. So, it's kind of a nuclear option, though. Well, if you want to file for this, then you better be looking for a new daycare. Well, even at that, you're not dealing with the most upstanding people. Do you really want them watching your kid? Credit for this, $24.41. This is not the entire form. This is first the top of the form. Basically, what we're saying here is that who's watching the kid, the name, the address, the tax identification number, and the amount that you paid this place. If you participate in the Dependent Care Benefit Program, the amount of expenses you may include or deduct is limited to $3,000 or $6,000 for 2 or more. $3,000 for the first, $6,000 for everybody, for everyone. So if I'm getting dependent care expenses tax-free from my employer for daycare, I have to take that amount of tax-free income and factor it in when I'm figuring the credit. Use that first $3,000 first, and whatever's left over, that's the amount of money that I can use to qualify for the credit. Determine the credit based on your work-related expense while you're working, or at least looking for it, or going to school full-time. Expenses for the care of the qualifying person only if the main purpose of that person is the well-being and protection. Expenses for care generally do not include the cost for food, clothing, entertainment, or education. This is just you're paying somebody to monitor. That's it. And all those other expenses should not factor in. Claudia's older child attends first grade private school, for Claudia pays tuition. After school, the child goes to child care. Claudia cannot count any of the school tuition as care expense, but she can count what she pays for after school care. By the way, latchkey counts. Even though you're paying the school district for latchkey, that is an acceptable expense, qualifies you for this credit. Claudia's younger child attends nursery school that provides some educational activities. Claudia can count the entire amount that she pays to nursery school. as child and dependent care expense. The amount of work-related expense eligible for the credit is limited to the lowest of the following: what you actually paid. Well, that makes sense. I can't get credit for more than what I actually paid. It's also limited by your earned income. Well, I can't pay out more than what I made. Well, that makes sense also. If you're married filing jointly, it can't be more than the smaller earned income of either one of you. Again, there's a certain amount of logic to that. If my spouse isn't working so much, they should be the one home watching the kid. I mean, that's just the way that is, unfortunately. There's also a set dollar limit: $3,000 expenses for one qualifying child or person, $6,000 for two or more. This $3,000, $6,000 limit must be reduced dollar for dollar by any dependent care benefits that you receive that are excluded for income. So back to our example, Barbara and her husband Grant paid expenses of $4,500 for their daughter. Remember, Barbara made $50. Grant is going to school for 5 months out of the year, so he's getting $250 a month of fake income for a total of $1,250. So let's look at some of the limits here that we're going to run into. The dollar limit for child care expenses is $3,000. Even though they paid $4,500, we're capped at $3,000 because there's only one kid. Their eligible work-related expenses to figure the credit is $1,250, because now that we got down to $3,000, we move on to the next limiting factor. And this next limiting factor is the lowest adjusted gross income or earned income of the two spouses. Grant only made $1,250. Therefore, the amount of credit that's currently available, and we're not done yet, is $1,250. Part 2 of the 2441, the taxpayer must identify each qualifying person. Enter the name, social security number, as well as the qualified expenses incurred and paid during the tax year. If the qualified expenses are paid for the care of two or more, the dollar limit on line 3 is $6,000, not $3,000 each. So once you got that second person on there, it's $6,000. I don't care how you get there, and you can bleed over. If you only paid $1,000 for one, you can do $5,000 on the other, because you have $6,000 total available. Because the $6,000 does not need to be divided equally. Joseph, two qualifying people for the credit: $2,000 to after school for his son, $5,050 after school for his daughter. Both children and the amounts paid are listed on 2441. He can take $6,000 of credit. Qualifying person could have no expense, and the second could have expenses. List 0 for the person that actually didn't, and second for the one that did. The $6,000 limit would still apply. So they're both in daycare, but one of them's free. Maybe one of them's being paid for by the state. That's a possibility. And the other one's not. Well, I still have a $6,000 pool. So here's the rest of the 2441. So we have the child, the provider's name, the child's name that are being provided for, or the dependent. Doesn't have to be a child. Remember, it could be for an adult who's incapable of self-care. And then we run down through here through the limits: the $3,000, $6,000, your earned income, spouse's earned income, the smallest of either one of those. And then on top of that, we go down into this area for to find out how much of a percentage of the expenses that are eligible to be taken are. Remember that $1,250 isn't going to be $1,250 of credit. We're coming up on it still. Like we said, part 1, we're identifying who provided the care. You must make every opportunity to get it. If you don't, you must then take notes from your person, put them into the return about what you did, when you called, who you called, to try and get that information that you needed for this tax return. So back to the 2441 for Barbara and Grant. See, so we're at 4,500, but we're limited to 3,000. And then we look at 50,000 for Barbara, 1,250 for Grant. The smallest of the two is the 1,250. And we're still working on it. Sorry. Alright, so got the 1,250. Irritatingly enough. So we got to look at the percentage. The percentage is based on your adjusted gross income. If your AGI is 15 or less, the credit is 35%. This 35% is the applicable percentage, but it's reduced by 1% for each $2,000 you made over 15. Excuse me. Oh boy. I wish they would just kind of get to the point here. We keep saying the same thing. So let's go back to this here real quick. And I apologize for this mess that it looks like. And we had Barbara and Grant. We're looking at this form. So to cover what I just said, it's taking a look at line 7 and say, okay, here line 7, we go down and get our percentage. They make over $50,000. So of the $1,250 of expenses that I was allowed to take, they can take 20%. That's the amount of the credit. It's not, like we said, it's not very great. And that, remember, that's non-refundable. But the advantage here at least is remember this credit is taken and used to pay taxes before we get to the child tax credit. So we could get more child tax credit. So, I mean, it's not totally useless, but it's not the strongest credit in the world. And then, like I said, I'm not going to talk about the adoption credit. It's really beyond the scope of this class. If you need it, talk to me. So, remember, tax credit subtracted dollar for dollar from income tax on a tax return. Non-refundable credit reduces or eliminates income tax but will not give an additional refund. Refundable credit reduces or eliminates the total tax and gives a refund of any amount the credit is left over. Child tax credit is non-refundable. Additional child tax credit is refundable. There are rules for the qualifying person for each credit vary, but you generally concern the age of the person, their relationship to you, their filing status, not married, filing separately, and where they live. Maximum child tax credit is $2,000, $2,200 now per qualifying child. Maximum will be reduced if their adjusted gross income is above certain limits. Remember, the phase out starts at 2 and 4. The amount of child independent care expenses is a percentage of the taxpayer's eligible work-related care expense. Child independent care expenses and the adoption credits are non-refundable. If qualified, I will mention this, adoption credit is up to $16,810 lifetime to adopt a child. And that's per child. So if you're adopting 2, each child gets its own lifetime pool. Don't forget to ask sufficient questions to exercise due diligence. And we are subject to the penalty if we don't. There's one last thing that I want to talk about that's not in these slides because it was part of OB3. And I want to talk about the Trump account for children. I did get a little bit more information about that since the basic class was taught. I watched a webinar earlier this month where they went into more detail about the Trump accounts. Remembering what a Trump account is, this is a $1,000 credit for any child that was born this year or for the next 4 years. There was some discussion of, and this credit, it goes into an account that is designed to be used later when the child turns 18 to be used to pay for expenses. Kind of like Coverdale Coverdale Education Savings Accounts, or here in Kansas they call a Star 529 account that you get that's through the state-ish. So here's this $1,000. It's kind of like it's kind of like Social Security in one regard. The government holds on to this in an account until it's called for. How do you apply for this money? I found out that there's a form 4547 that will be filled out to get this $1,000 credit, this $1,000 Trump account. Again, in regards to get this $1,000, it's part of the tax return, but it's not anything that actually shows up as far as like $1,000 credit on a refund or anything like that. That's not the way it works. That's how you establish this Trump account. Fill out form 4547, file it with your tax return. It might be able to be filed alone. Nobody did say that, but given the nature of what's going on, I would imagine that it should be available to be filed by itself as a standalone form. All right. So that's this chapter. Let's take a 5-minute break, and then we'll talk about our last chapter I wanted to talk about for this series: profit and loss from business. Again, I'll see you back in 5 minutes. Okay, I'm sorry about that. I went over just a little bit. Got a little distracted. Last chapter that I'm going to cover in the scope of this class, keeping in mind that the book itself has 20 chapters, and I'm not covering all 20. There's a lot of information that we're not covering because it's just not in the scope of a rapid class. Can you do a tax return based on of learning from rapid class? Yes, some of our best tax preparers started in rapid class. But I will also say that if your only exposure to taxes has been through rapid class, take a basic class. You need it. There's a lot of information that you're not been exposed to yet. Take it, watch it. I've got it uploaded here to the same place where you're watching this series. You need that information. You need to fill in those gaps of your knowledge. So we're going to talk about self-employment, Schedule C, income and expenses, profit and loss. We're going to talk about business use of the home. I cut out the Schedule F part because F is just C for farm. So if you could fill out a C, you could do an F. So I cut it all out. There's no reason to talk about it. Basically the same thing twice. And self-employment tax. So we want to understand what self-employment is, how to do Schedule C, how to take a look at the home office deduction options, the 8829, and some talk about self-employment tax. So you are considered self-employed if you carry on a business or trade as a sole proprietor, you're an independent contractor, you're a member of a partnership, or you're in business for yourself in any other way. Did any work for money? It's a little bit more complicated than that, but let's just start off with that idea. An activity qualifies as a business. The primary purpose for engaging in the activity is income or profit, and you're involved in the activity with continuity and regularity. Business does not have to be full-time. It could be a side. If you own a business alone and not have incorporated, you're considered a sole proprietor. An independent contractor is the sole proprietor. For an example, I am an independent contractor. I participate in some medical research studies through an outfit here and locally. Currently involved in one for a cholesterol drug. Every time I show up, they pay me $100. The entire study is going to pay me over $1,500. So, I mean, it's a nice little side hustle that I'm going to report on Schedule C as independent contractor income, because I'm going to get a 1099 NEC for it, and that's where it's going to show up at. If you own and operate a business by somebody else, you may be self-employed as a member of a partnership. Any income you earn from the business activity must be claimed on your tax return, even if no reporting documents are received. So even though I used to mow lawns for a lady, and she paid me cash, she never sent me a 1099, I still reported it as income. That's what we're saying here. If the net earnings for self-employment are at least $400, you have a filing requirement, because you owe self-employment tax is basically the reason why. The source of your income and the involvement in the activity will determine whether it's self-employment income. The following are some sources of self-employment income: income from a part-time business, income you receive as a sole proprietor, income you receive as an independent contractor, any self-employment income you receive from activities in U.S. possession, well, even worldwide possession at that point. Rent from real estate or personal property leased with real estate, only if you're a real estate professional. If you're not a real estate professional, that's Schedule E stuff. And again, that's one of the chapters that we don't cover here. Let's see here. Income you receive as a real estate agent. Income paid by insurance companies to you as a retired agent. Income passed through you from a partnership, Form 1065, Schedule K1. Self-employment does not include rental income from real estate and personal property leased with real estate. That's Schedule E. It is not interest income. It is not dividend income. It is not capital gains or losses. Business income information may be reported to you through your ledgers, through your own receipts of income collected, receipts, deposits, etc. You also might get a 1099 NEC for non-employee compensation. You might get a 1099 MISC. That's what was used before the NEC. NEC was trying to kind of take place of it, but the 1099 miscellaneous still exists. The box 7 for non-employee compensation is still on that form, so it could be either one of those. 1099K, payment card and third-party network transactions. You might get this from PayPal. You might get this from Cash App. You might get this from Zillow. You might get this from Visa, straight, depending of what agreements that you have made. You might get it from a W-2 with Box 13 check to indicate that you're a statutory employee. You might get it from a K-1 that was generated from 1065, a partner share of income. If you're self-employed, you report your business income and expenses on Schedule C. Your business income, your expenses. If your spouse has a business, even if it's the same business, so say that you and your spouse are in a partnership and running a business together, you could just put it all on one Schedule C. That is an option. But any self-employment tax is only going to go to one, whoever's the business name is going to be under, which in the long run kind of sucks because, here's my example. Is I had a husband and wife. They were doing a trucking company. He is the driver. She was the books. They wanted to just, it's his business, but it's not. She did the books. She was dispatch. Well, if I did it the way they wanted to, she wouldn't receive any credit for Social Security in the future, because that's what part of self-employment tax is, Social Security payments. If I did it the way they wanted to, she would receive absolutely no credit. The other option was a partnership. It could be 50-50, 60-40, however you want to look at it. I did 50-50. They agreed to 50-50. So 50% of the income was his, 50% of the income was hers. 50% of the expenses was his, 50% of the expenses was hers. Yes, it's 2 Schedule C's, 2 Schedule SE's, but now both of them are getting credit for Social Security. If you're self-employed and have more than one business, report the income and expenses on each business on separate Schedule C's. That's if they're inherently way different. Now, if you have a business making fishing lures and another business doing lawn care, yeah, that's 2 Schedule C's. If you have a business doing lawn care and you have another business, that same business is also doing snow removal and hanging Christmas lights, that's basically kind of the same business. I'm not going to do 2 Schedule C's for that. Unless I absolutely have to. Unless you're calling it 2 different businesses, then I would. And this is what I just talked about my example earlier, so I just wanted to get it out there. But businesses owned and operated by spouses together. That's what this just covered, and I already covered that. And this continues on with what I just was talking about. Statutory employee is something we talked about. I might have seen it once or twice. That Box 13 checked on a W-2. That means that they're kind of being treated as an employee for payment. Social Security is being collected and all that on the W-2. But if I can prove expenses, out-of-pocket, unreimbursed expenses, I can put them on Schedule C and decrease their income tax. All income you report is all income you earn is reportable. However, many of these sideline occupations are really hobbies. Like I said the last time, if you're running a business and you say you don't have any expenses, are you truly running a business? Also, if you're running a business and you're not keeping any logs, any journals, receipts, are you truly running a business? You're not behaving in a business-like manner. A hobby is not considered a business because it's not carried on to generate profit. How do you know if you're generating profit if you're not keeping the books, except doing it once a year at tax time? That's not sufficient. But if you're just doing it as a side hustle, well, I like making Christmas cookies and I'll sell them, but I don't care if I actually make any money at it. That's a hobby. That money goes on Schedule 1, line HA of other income. It's not earned income. It won't help you qualify for earned income credit. It might hurt you. Used to be I could take off my expenses up to the amount of my earnings for hobby income on Schedule A, but since 2018 that's no longer allowed. One indicator of whether an activity is considered a business or a hobby is the presumption of profit. I have a profit motive. An activity is presumed to be carried on for profit if it produces profit in any three of the last 5 tax years, including the current one. There are some businesses that are a little harder. So, for instance, they have racing horses, 2 of 7. Oh, okay, well, this isn't Kentucky, so I'm not worried about that. If your activity is not considered carried on for profit, your deductions and losses may be limited by the hobby rules. The IRS can come back and say, "Hey, you're not cutting it. We're going to limit you. You can no longer file a Schedule C based on this. This is hobby income." It says, if a business cannot meet the 5-year rule, it does not necessarily mean that the business is not carried on for profit. It's a flag for the IRS. It's not an automatic thing saying, "Oh, well, you didn't make money enough in the past 5 years, so automatically." No, because they're going to look at some other things. Do you carry on the activity in a business-like manner? Again, are you keeping receipts? Are you keeping books? Doing business-like activities. If you're just doing your books once a year, that's not business. Does the time and effort you put in the activity indicate you intend to make it profitable? Are you really putting your heart into it? Or are you just kind of showing up whenever you feel like it, and if I make a little money, then I make a little money? Do you depend on it for your livelihood? Is it your only source of income? Are the losses incurred due to circumstances beyond your control? COVID. Just about everybody lost money that year. Or, another good example is, are you in the startup phase of your business? Yeah, you're going to have a lot of expenses when you first start up. There's no control for that. You're not going to have a lot of customers when you first start up. They don't know about you. So you're not going to have a lot of income. The IRS does take that into consideration. Have you changed your method of operation to improve profitability? You know you're losing money. What are you doing to fix it? Do you or your advisors have the knowledge needed to carry on the business or the activity as a successful business? Do you know what you're doing? If you're a landscaper, do you have a green thumb? That's not actually something you quantify, but, do you have a degree from K-State in horticulture? Did you work in the industry for multiple years before you went on your own? Or is it something, hey, that looks simple, I'll just start doing that? Have you been successful in making profit in similar activities in the past? Well, I used to have a lawn mowing service, but I sold it. Or I moved. I couldn't keep the clients. I got to get new clients, so it's taken me some time to get back up again. But I can prove I know what I was doing because I used to do the same thing and I made money at it. Does the activity make a profit in some years? It kind of goes back to, situational. Can you expect to make a future profit from the appreciation of assets used in the activity? Hey, I might be losing my shirt on the books because I've got a lot of items in depreciation, which we're not covering in this class, by the way. That's an entire chapter. But I got a lot of expenses just tied up in depreciation. Yeah, so when you're looking at the books, yeah, according to the IRS, I'm losing my shirt. I'm looking at my bank account. Hey, it's been going up. There's a difference between tax books and bank books, and this is one of the reasons why. Depreciation. I've already expensed it out of my bank account when I paid for it back when I bought the stuff. But according to IRS rules, anything expected to last more than 1 year, I need to depreciate. Business records are used to prove the source of your income as well as to support deductible expenses and credits. Records must always be available for inspection by the IRS. Business checking account is one of the ways that they think that you should do that. Hey, get a credit card for that, Go get a prepaid. Set up a Venmo account for it, whatever. Just so you can kind of keep this apart from the other. Do you have to? Do you have to keep your bank account, business and personal, separate? No, it's not a requirement. Does it help? Yes, especially when it comes to income and expenses. The only thing that's going into this account is, income from the business. The only thing coming out of the account is expenses from the business. All right, so they want receipts, canceled checks, deposit slips, bank statements, credit card statements, whatever you can find. Keep that. Scan it into the computer, because here's the thing. You remember, it's not as bad as it used to be, but thermal paper, credit card receipts, and stuff like that, they'd eventually fade out. Well, 7 years from now, during an audit, if the IRS can't read it, they throw it out. It might have been your most expensive thing for the entire year. And the difference between making money and losing money was that receipt right there, and he can't read it, so he's going to throw it out. Scan it. Save it to the cloud. Amounts spent on meals, travel, and gifts are subject to additional documentation requirements, especially when it comes to meals. I just can't go out and buy myself a Quick Trip or a McDonald's or even Scotch and Sirloin for that matter, unless I have other reasons. To be deductible, all expenses must be ordinary and necessary expenses of carrying on the type of business that you are in. So I'm not so keen on the Bible salesman writing off the visit to the strip club. It's not ordinary and necessary for the Bible salesman. Schedule C is multiple pages, and some other pages that even get attached to that, like depreciation. Like I said, we're not covering it. Home office expense, we'll cover that a little bit. Schedule SE for self-employment. Schedule C is broken into 5 different sections, so let's talk about them. And like we said, here's what our Schedule C looks like. For each business, you make your own new Schedule C. And remember, the only one proprietor. I can't put a joint on here. So if we have a joint venture going on between husband and wife, we split it before we fill this out. So first we start with the taxpayer's name or spouse's name and social security number. Then we say to the IRS, what are we doing? Let's see here. Then not only do we tell them what we're doing, we put in a code. The IRS has codes. I wish they were better. You can look them up, and it's hard. Try and get as close as you can. Each code, there should be a code that describes at least vaguely the business that you're in. Sometimes it's specific. We'll find out here in a minute, if I didn't delete it, that there is a specific code for tax preparation services. Sometimes it's just hard. Do the best you can. Get as close as you can. Next, if you have an employer identification number, enter it here. I strongly recommend getting an employer identification number if you're self-employed. They're free. You fill it out by going to the IRS website, fill out the form, and sending it in. It takes 20 minutes. It's easy. It doesn't take anything at all. They send you back a letter from the IRS that has your employer identification number, and then you can use that at vendors and such instead of giving them your social security number all over town. Like I said, it's free, it's easy. If you don't have an EIN, don't put anything in here. Don't pull an EIN off of somebody else's 1099. That's not what that is. This is for you. So we have Mr. Patel, tax preparation business called Many Happy Returns. EIN of his business is this. And so we see that he's got it entered in here. Here's our client social security number. Here's the employer identification number. And the tax code, or the code for tax preparation services is 541213. Schedule C, line F, to indicate your accounting method, whether you do cash, which is most of the people, or whether you do accrual. And I'm not getting into the difference between the two. Let's see here. If you materially participate in your business, or if you perform business activities on a regular, continuous, and substantial basis, are you participating in the business, or are you just getting kicked? I'm a member of the business, but I really don't have any say in it. Well, if that's the case, if the business is losing money, you're going to be limited. And different rules, different situations. Line I, if you made payments that require you to fill out a 1099 and send it to somebody else, check here. So if you contracted out and you need to send somebody a 1099 NEC, tell the IRS that you needed to, and then indicate that you did. And if you didn't need to, then leave it at no, don't do anything. Next, income. How much money did you make? Well, if I'm filling out 1099 NECs, the program will automatically carry it into this area. Same goes for the K1 from 1065, the W2 box 13. The other thing is, though, is that I have to come in here. If I'm working off of receipts, I have to manually enter that number. Gross receipts. This is the total sum of cash, checks, and other payments I receive from clients. Don't include sales tax that you receive, though. That's not your money. You send it straight on to the state, so you don't report it as income. You also don't report it as an expense, because since you didn't report it as income. So you're just saving yourself a step. Hopefully you received a 1099 NEC. That's a good example of that you're actually in business. Like I said, I'm expecting one this year. So that gives us a gross profit. It's generally equal to the gross receipts and other income. In manufacturing, which most of our clients are not, most of our clients are service-based. They're selling their service. They're selling their expertise. They're not selling cookies. They're not selling fishing lures. That's something totally different. Most expenses you incur in your business are deductible. Again, to be deductible must be ordinary and necessary. Ordinary, those are common and accepted in your type of business. Necessary, those are appropriate and helpful to the business. I mean, our business is a great example. It's ordinary expense for me to buy a printer toner. And it's also necessary. Otherwise, I'm not printing on any tax returns, am I? Some of the individual expenses that are in here, we're going to go down line by line. Advertising costs. Promotional costs paid to enhance the business are deductible. Some examples of advertising costs include classified ad, business cards, mailers, television spots, radio spots, promotional brochures, Now, yeah, I've seen that advertisement every once in a while for uh, the logo company. Buy the stuff that has your logo printed on it, whether it's shirts or cups. Well, that's all advertising expense. Next, car and truck expense. I'm only going to talk about in regards of business miles. That would go into this section here. You could also use actual expenses. I'm a little bit more, little less resistant on business actual expense for um, car and truck expense in a business, especially if the truck is only used for business. Commissions and fees, don't see that very often. These are monies that you pay to somebody else um, to help you enhance your business. They say it for contract labor. No, there's another place for that. This is something specific as far as I'm concerned. So contract labor is the next line. Amounts you pay to independent contractors. If you paid somebody $600 or more, you have to issue a 1099 NEC to that person. 12, depletion. Never really filled that out. It's a part of depreciation. So, I do. I will take that back. Depletion for it's a form of depreciation used specifically in natural resources. Because basically, once you take the oil out of it, it's not going to grow back. Employee benefit programs only applies if you actually have employees. Our clients generally do not. Insurance, you bought insurance for the company, through the company, you can expense it here. Do not include health insurance, that's its own different line. This is just business insurance, whether it's on your property where your business is actually located or your truck for your business. Interest that you paid on any loans used to finance your business is deductible. That would go on this line. If I'm doing home office, I could take a portion of interest I paid relative. Just put a pin in that. We'll come back to that in a little bit. Legal and professional services. This includes fees for tax advice and tax preparation, as well as legal fees related to business matters. Yes, I'm an expense when I figure my taxes for my client who has a Schedule C, but I can't expense the entire return. I can only expense the business-related parts of the return. The Schedule C, the Schedule SE, the depreciation, whatever else form I have that directly ties to the business. Those are the expenses. I can't do Schedule A. I can't deduct the price of the 1040. Office expense, this is very vague because there's another one coming up later that's called supplies, and to me they're kind of redundant. This includes the cost of consumable office supplies such as paper, toner, and postage. Yeah, that's fine. Pension and profit sharing plans, again, if you don't have an employee, we're not worried about it, so I don't spend a lot of time here. Rent or lease, payments are deductible. If you're renting, obviously when Brett pays the landlord for us to have our offices where they're at, yep, that's an expense on his Schedule C. Repairs and maintenance include the cost to repair and maintain the business property, tools, and equipment. This includes snow removal, lawn care, cleaning service, labor supplies, and other items you spent on repairs and maintenance that do not add value to or increase the life of the property. We've got a lawnmower here, so let's just use that as the example. It's one thing for me to say it's an expense to get the blade sharpened, put in a new spark plug, replace the air filter, change the oil. That's all repairs and maintenance. If I replace the engine, now I've added to the value of when I've increased the life of the property. That's not an expense. That's a depreciation unit. And again, that's beyond the scope of this. So be very careful about you just can't take everything at face value. You need to think about it a little bit. Is this an actual expense? Is it appropriate for my business? And is it actually an expense, or is it something I need to depreciate? Supplies include the cost of materials and supplies not included in inventory costs. Again, to me, this is redundant to office supplies. There's no necessarily wrong answer. If I put pins in office supplies, or if I put pins here because they're showing colored pencils, it's not a wrong answer. It's not like the IRS is going to come back and say, "Oh no, you should have put that over here." No, that's not what they're doing. They don't care. Taxes and licenses directly related to being in business. So, say, like if I have a highway tractor driver, which is the official name for a truck driver, and they pay their federal highway use tax, that is an expense that is going on Schedule C. Do not include real estate taxes paid on your home, although I could take a portion of it if I'm doing the home office deduction. Payroll taxes, again, I'm not worried about this if I don't have employees. Sales tax, only if I reported it as income. There's certain states that allow you to do it like that. But if you didn't report it as income, don't report it as an expense. Travel and meals related to the business are deductible. In general, only 50% of the cost of business meals are deductible. For a couple years, it was 100% because the government was trying to stir on businesses at restaurants, but that's no longer in effect. So, cost of business meal. So let's just be careful about that, and don't do anything extravagant unless it's appropriate. It's one thing to be in business mowing lawns and you take Joe Blow out to dinner at Pizza Hut or something like that. Well, you talk business, and remember, it's got to be about business. You just can't be doing it because you like Joe and the two of you get along. No, you're going to talk about business. Some aspect of business is going to be handled during this meeting, or immediately before, or immediately after. Utilities, gas, electricity, water, trash, internet, phone, business use of your cell phone. Again, it's a percentage between personal and business. I can't deduct the entire cost of your cell phone bill off on Schedule C unless it's exclusive to the business. And if you're going to tell the IRS that my phone bill is exclusive to the business, you better have 2 phone lines. And you better carry 2 cell phones. One for business, one for personal, or the IRS is going to reduce your deduction. Wages, again, this is if you have an employee. Other expenses. This is anything that doesn't fit in the categories that were above. Put them here, listed out specifically. I do truck drivers a lot, and so this is places where things that I would put in this area under other expenses: showers, scales, trailer clean out, diesel. I could put diesel back in fuel expense or under auto and car, but it doesn't really fit there very well, because again, the whole thing is about this truck. That's the part of the business, and so I list out diesel separately as a line item. Is as a truck driver, well, that's the single biggest expense. They might make $100,000. Or $400,000, they're going to spend $100,000 just in diesel. And so I don't want that expense buried someplace where the IRS, well, what's going on here? I need to audit this guy so I can figure out what the heck this big expense is. I have it listed specifically by name in other expenses where the IRS person can take a look. Oh, yeah, diesel. Well, that makes sense for the nature of what you're doing. Okay, that expense works for me. I don't need to audit this person. Once we get the expenses totaled, we compare that line 28 to line 7 of my gross income, and it gives me a tentative profit or loss on line 29. Then I might be able to deduct expenses for the home business use of home at line 30, And once I get done with that, I have line 31, net profit or net loss. If I have a net profit, it goes to line 3 of schedule, or if either way, line 3 of schedule 1. If I have net profit, then I also take that number back to schedule SE to figure out my self-employment taxes. Now, if you use part of your home for business, even if the business is not full-time, you may be able to deduct certain expenses for the business use of your home. The home office deduction is available for homeowners and renters, and doesn't matter what type of home it is. You qualify for the business use of home, you can deduct either a set amount or a portion of your actual expenses. May be limited depending on your business profit. To deduct expenses related to work at home, both of the following tests must be met. It's the principal place of business, and it has regular and exclusive use. I'm coming to you from my home office, but I can't deduct it because, first of all, I don't do my business here regularly. I go to the office. And second, it's not exclusive. This is also where I do my personal internet use, and this is also where my ham radio is set up. So it's definitely not exclusive. There is an exception to exclusive use. That's daycare. The kids are running all over the place. I just can't designate one part of my house. They have to go all over because we're going to be using the kitchen. We're going to be using the dining area. They have to go to the bathroom. So we're going to take a look by not only square foot of what's available to them to play in, but also how many hours. And again, I'm not going to get into a lot of detail. This is outside of the scope of a rapid class. Storage of product or samples, again, doesn't just because it's exclusive and exclusive use doesn't mean I have to use it all the time. As long as I don't, it's okay for it to be empty. I just can't put my Christmas decorations in there if it's, when it's not Christmas. Your home must be the only fixed location of your trade or business, and you use separately identifiable space for storage regularly. Again, I don't meet this test. Well, first of all, I have no need for storage. I'm not selling goods like cheese wheels. To deduct the actual portion of expenses related to your home, use 8829. So first we need to figure out my business area of my home. I could do it by square feet. The IRS is fine with any reasonable determination method. And most of the time it's going to be square feet. You look at the entire area of your house, and then you look at the area of your office, and then come up with a percent. Once you got that percentage, then you can go through and do indirect expense. So I can take a percentage of my house insurance. I could take a percentage of my mortgage. I could take a percentage of my real estate tax. I could take a percentage of my rent, my repairs and maintenance, my utilities, so water, gas, internet. All that can go into here under indirect expenses. Direct expense is something that is for the business and can be attributed, all the expenses can be attributed just to that one area of the house. So if I decide to have my office painted, that's a direct expense because I can have a bill from the painter just for him painting that one room. Carpet, same way. I can ask my carpet layer to break out the expense for carpeting this one room and that's a direct expense. Indirect expenses are household. I have to take a portion of it. Direct expenses, I could tie it straight to that. If I have a phone line coming into the house just for the business, that's a direct expense. If I have a cell phone that is business only, that's a direct expense. Which I've just covered this whole slide in what I just said. There's also a simplified method to do this. You make two direct lease entries on Schedule C, the square footage of the entire home and the square footage of the office. And then basically they go at $5 a square foot, more or less. So, and I did the math on this once before. Yeah, the simplified method works up to 300 square feet, and if you go over 300 square feet, then go back to the other form. Don't use the simplified method. And it says right here, 300 square feet or less, then the simplified method would be better. And of course, daycare has its own thing, because not only do I have to worry about my square footage is going to be bigger because the kids are going to run through more of the house, but I also have to figure in hours that I'm open. I will talk about daycare just a little bit, but not much. So on daycare, the cost of providing meals and snacks are also an acceptable expense. You could use either actual expense, or you can use a table that the IRS has provided. Um, Breakfast, lunch, and dinner. You have to keep track of how many kids had breakfast, how many kids had lunch, how many kids had dinner, how many kids had a snack, and I can have 3 snacks a day. And keep a log, keep a tally of it, of who did what, so you can prove your expenses. So if you're self-employed, you're subject to self-employment tax. It sounds bad. It does suck when, especially when you got to cut the check, but it could be to your long-term benefit, because what's self-employment tax? It's your Social Security and your Medicare tax. So you must follow Schedule SE to figure self-employment tax. If your net earnings were over $400 or more, or had this church income of $108.28 or more, but we're focusing just on the 400 or more. Self-employment tax is figured on net income from all of your self-employment. And so if I made money in one business and lost money in another, do the math. Then figure self-employment tax. You and your spouse must file separate Schedule SEs if you both have self-employment income. Because remember, this is for your Social Security, your Medicare. Self-employment tax you owe is not paid directly as withholdings to the government or any other agency, yet is part of your tax return. This is where you can get into a big lot of trouble, because, self-employment tax. It's basically a little over 15%. Is that slide still on? Yeah, it is. 15.3% of that 12.4 is for Social Security tax. 2.9 of that is for Medicare tax. And so you need to keep track of this for your quarterlies. Your client needs to do their books at least quarterly to make sure that they're sending in a proper amount of money as a quarterly payment, so they don't get too far behind on self-employment tax, or otherwise they could be looking at next April having to cut a big check and also being exposed to underpayment penalty. I had a client, and it was a pretty good business for him. He had minimal expenses. He had some, but he didn't have a lot, and he was paid handsomely because he was a pilot and he was a contractor. And so when we figured this out, he would run his books real quick and then figure his net profit for the quarter, and he would send in 30% of that number. Why 30%? Because this 15.3 already represents self-employment tax. He sent in 30 because the other 15%-ish was representing income tax. Now, for him, it wasn't enough. He really needed to do a little bit more, but it was enough to keep him off of underpayment penalties. Self-employment tax, the number from SE goes to Schedule 2, line 4. Half of this number will also go on to Schedule 1 as an adjustment down to income. When you work for the man, they pay half of your Social Security tax. Well, when you are the man, you pay the whole thing. But at least you get to write half of that self-employment tax off, so you don't have to pay income tax on at least a portion. Usually includes all business income, less all business deductions allowed for income tax purposes. You must claim all allowable deductions when figuring out your net self-employment income. Of course, why wouldn't you? Your net self-employment income is used to figure your net earnings from self-employment. If you have more than one business, combine the nets of all of them to determine your self-employment tax. I might have multiple Schedule C's, but I'm only going to have one Schedule SC. Can be exempt from self-employment tax if you meet these following examples. Children under the age of 18 working for their parents in a sole proprietorship. They're not subject to self-employment tax. Termination parents of former insurance agents. Well, we're not worried about that. Individuals with a country with an an international Social Security agreement. My Canadians. One of them is a real estate professional. She's self-employed, but she's exempt from American self-employment tax because she pays into Canadian, or she's exempt from American self-employment tax because she pays into the Canadian system. Members of certain religious sects with approval of 4029, clergy or ministers who have an IRS Form 4361. So members of certain religious sects, so like say for instance, Amish don't have to pay self-employment tax because they don't participate in Social Security. Clergy and ministers, so you're looking at maybe like your Catholic priests taking a vow of poverty. They filled out the 4361. They also don't have to pay self-employment tax because when they retire, their church will take care of them. So a sole proprietor is a person who owns a business and has not incorporated the business. If you're a sole proprietor or statutory employee, report your business income and expenses on Schedule C. Each business has its own Schedule C. Each person has her own Schedule SE. Generally, Form 1099 NEC Box 1 shows non-employee compensation reported that was paid to the person. If you have received this form rather than a W-2, you're considered to have been self-employed, and Social Security was not withheld, neither was Medicare tax. You need to do self-employment income, figure your Schedule C, figure your Schedule SC so you can get that taken care of. You must obtain an employer identification number if you have employees. I recommend that you do it even if you don't. All income must be reported even if you don't receive a 1099 NEC. That's in the form of cash, goods, or services. You have to put down the dollar equivalency. Remember the story that I talked about, that mom episode to begin with, where she was living in the place for free because she was providing the building supervisor activities. That's income. You may be able to deduct the expenses of the portion of your home in which you conduct your business. Daycare providers can use the standard rate for meals and snacks instead of actual costs, which I recommend. If your net earnings from self-employment were $400 or more and you had income of $108.28 or more from a church, you must file a Schedule SC. Self-employment tax rate is 15.3%. That's 12.4% for Social Security, 2.9% for Medicare. Higher income taxpayers may be subject to an additional 0.9% of Medicare tax. We're not worried about it in our office. And again, due diligence is very important. If it doesn't make sense, if you're doing a return of a business that you're not finding expense you expect to find, you need to ask about it. If the income doesn't appear sufficient, if the expenses don't appear sufficient for the volume of what's going on, you need to ask about it. What's going on here? All right, so that is the rapid class. I thank you for putting up with this. Actually, I thought it worked out relatively well compared to the basic class, so I'm going to try and figure out how to do the basic class in this similar setup. I didn't have any in-seat people for the rapid class. That's the reason why I was able to do it this way. But I'm going to figure this out. So I'm going to get this taken care of for next year. And so good luck. Have a good tax year. And if you ever have any questions, give me a call. Don't guess. Give me a call. I'll either to point you in the direction. I'll either help you get the answer or I'll point you in the direction to find your answer. So no guessing. There's no shame in asking the questions. I'm not going to sit there, oh, yeah, hey, this person called me 20 times this year, Brett. I don't think she's any good. So, no, I don't do that. I actually would rather say, hey, she called me 20 times this year. She knows when she's in over her head. I respect that. You know, that's actually a good thing. So, don't worry about calling me. I don't look at it like that. We want quality work. I don't like IRS letters. So, we'll see you next time.